Okay, the community's asked for Cardano. I'm just going to run through this quickly for you guys. It's going to be a quicker video than usual, so let's have a look at Cardano. There's two things that I'm seeing here from Cardano. One thing, a major thing, putting a new bear market low recently within the last week and a half, putting a new bear market low. It hit 21 cents, just over 21, nearly 22 cents. So that's where the low was. What happened when it hit the bear market low? Remember, clues from the candles, clues from the candles. So at some point, this body went all the way to the bottom, all the way to the bottom. But then the bulls regained momentum and pushed price action right back up and created a bit of a base here. So where's this base sitting at? You've got the body sitting at 25.92. You've got the wicks. Got the wick sitting at 25.29. So those are key areas from me. And from a trading and an investment perspective, I'm looking at this differently from a dollar cost average perspective and positioning myself for the next run. This makes sense to me, dollar cost in small amounts with the intention of it's going to go two ways, up or down. Are you preparing yourself for either way? Because if it goes down, your next support's going to be this low here. So from a dollar cost averaging perspective, if it goes back down to 21 cents and 99, 0.2199, if it goes down to that, what you can do is you can bring your position down. You can average. So let's use an example of $25. So you got $25 here. You got $25 at 26 cents. You come back down to 22 cents and you got $25 at 22 cents. So you're between 26 cents and 22 cents. Your average is going to be 24 cents. So this is the power of dollar cost averaging. You put all your eggs in one basket here, and this slams to the downside, you're in a loss. You can't take advantage of it. You haven't planned. You haven't put the appropriate risk management in place. You're not positioning yourself properly for the next run. So that's what you need to look out for from a trading perspective. Okay. None of this financial advice. From a trading perspective, we're in a bear flag. Not a bear flag, a bearish triangle. So we're in a bearish triangle. There's a higher probability that we're going to make a move to the downside. So what we can do is we can just build in this triangle here, and we can see whether the bulls or the bears are going to regain momentum by looking at the break. Okay. So if it breaks to the downside, if it breaks to the closer to the downside, you've got your stops above here. And then you can either be shooting for the previous low, which is here, 21.99, or extended targets, which could be a Fibonacci extension. Let's build one of them in. So a fib extension, top to bottom, back up to top, back up to top. You can see straight away here, 1272. That is sitting at 17 cents. You got your 1272 sitting at 17 cents. And you can see this base that we've created here is a 786 of the previous move. So it's holding support at that 786. So that's one good thing. And those are the key levels. If you move into the downside, I've got 1761, which is the 1272 extension. You've got your previous low here. Remember, that's sitting at just under 22. So that's sitting at just under 22. None of this is financial advice. Make sure you apply the appropriate risk management. If you haven't got a good risk management, it's not worth taking. You analyze and you move on, guys. So let me just go over what good risk management would look like on a trade like this. So if you were expecting a move to the downside, you've got your short position. It's very, very, very much dependent as well on this, guys. So if you were shooting for the 1272, you've got 2.31 risk to reward. Is that worth it? I'm asking you the question. If you shoot into the previous low, which is more likely, it's more likely to get a reaction back at this previous low, and this is more likely to act as strong support going forward, you've got a 0.8 risk to reward. Is that worth it? If you were shooting for the 1272 and you got a huge candle to the downside here, just say it closed here. Remember, when you're entering, you're waiting for the candle close. You're waiting for a confirmation that it has broke to the downside. You've got a huge candle here. So what would happen if you had a huge candle there? Brings your risk to reward down because you're always putting the stop loss above the previous high. So you're putting your stop loss above the previous high, in this case, above the top of the wedge or the top of the triangle. it doesn't allow for good risk to reward. 0.7 to 1, it's not worth it. So depending on what you're doing, guys, make sure you do use the appropriate risk management. Make sure you've got your stop losses in play, and obviously you take profits. Know where you're going to take profits. And this is just tutorial. This is just education. It's something that I'm going over by the request of you guys. None of this is financial advice. I'm not even taking this. I'm bringing it to your attention. As far as investing is concerned, I'm interested. As far as trading is concerned, not that interested, unfortunately, guys. So take care, enjoy the rest of your day, and goodbye from me.